I'm Sebastian St. James. How much of your money should you invest in the US? And how much of your money should you invest in Australia? Is investing 100% of your dollary dues in the US a good idea, or is that strictly a dollary don't? In a previous video, one of my viewers asked, I invest in both Australian ETFs and US ETFs. Presently, my allocation is a smidge more in US ETFs. I don't know if there's a percentage allocation sweet spot for the two. Good question. And yes, I am copying his emoticon. Oh, and here's a question from Craig, which is basically asking the same thing. So with two people asking this question, we need an answer, and we need it now. This is Stephen. He loves dividends. He believes his wife's grocery money should be paid by them. No dividends, no groceries is his motto. Stephen, that seems a bit harsh, but okay, each to their own. This is Kylie. Kylie is terrified she'll make a mistake. Well, I've got news for you, Kylie. You're going to be bitterly disappointed several times a week. Kylie would like to allocate her stock portfolio to the right countries. That's very important, and Kylie does not want to make a mistake. We'll see what we can do for you, Kylie. This is Justin. He likes to min-max his portfolio. He wants the maximum return, and he doesn't care how he gets it. Or at least you're ambitious. So let's start with Stephen. If you're an Australian and you love dividends, which is exactly what Stephen is and does, how much of your money should you be putting in Australia, which we know is rich in dividends, and how much should you be putting in the US? Well, let's have a look at the data. This is the XJO over the last 30.2 years. What is the XJO, I hear you ask? That is the ASX 200. And this is the XJTF over the last 10.1 years. And that is, well, it's basically the XJO plus dividends plus franking credits. So I have a graph showing you the return of the ASX 200. There it is. And I have a graph showing you the return of the ASX 200 plus dividends plus franking credits. If only I could somehow subtract the numbers, I would actually get the dividends themselves. Oh, wouldn't that be amazing? The good news is I have a superpower. I know, one of many. And this is my own graphing software, which I write from scratch. And that gives it a special ability. Let's take a look. So this is the XJO, which is the ASX 200, versus the XJTF, which is the ASX 200 plus dividends plus franking credits, and they're actually graphed in exactly the same space and within the same time period, which is 10.1 years. So why 10.1 years? Well, that's the maximum data I have where both indices exist. So over that time period, the XJO, the ASX 200, has returned 61.4%. If you add in franking credits and dividends, you get 182%. So XJO without anything is 4.86% CAGR, compound annual growth rate. And if you add back in the dividends and the franking credits, you get 10.8. Good. But how do I figure out how much the dividends are from that? Well, because we now have the compound annual growth rate, we can actually just subtract the numbers. I know, it's amazing. So we take the XJTF, which is absolutely everything, which is 10.8%, minus the XJO, which is just the price return part, and that gives me 5.94%. Wow. 5.94%. What is that exactly? That is the dividends plus the franking credits. So that's every part of the dividends grossed up. Does that sound right? Does that pass the sniff test? It's always a good idea to ask that question. Well, it does. In Australia, the dividend yield is roughly around about the 5%. So if we add in the franking credits, 5.94, yes. 2 thumbs up. That certainly passes the test. Wow, that seems so easy to work out. Yes, it is. If you write your own charting software from scratch, you carefully collect all the historical data, and you implement your own accurate CAGR formula, then you can simply subtract the two numbers. It's that easy. This is the XPX. What's that? Well, that is the S&P 500 versus the XPXTR, which is the total return version of that over 35.1 years. Now, the return of the XPX over that period is 1,480%, or a CAGR of 8.18%. If you add in the dividends, then it's 3,260%, or 10.5% CAGR. Straight away, I noticed something different about these numbers. They're actually a lot closer, aren't they? Let's put them in a table and subtract them. So 10.5 minus 8.18, which is removing the price component of it, leaves you just with the dividends. Of course, there's no franking credits on US stocks. So there's 2.32%, which is not really high, is it? Wow! We can see now why Australian markets are preferred for people who love dividends. A massive difference. What? Nearly 6% versus 2%? It's the choice is yours. Now, that's all the data I have over the indices that we looked at, but they are of different time periods. So let's now combine them all together and see exactly like for like. So here is, wow, it's absolutely everything, isn't it? It's the S&P 500 with and without dividends. It's the ASX 200 with and without dividends and total franking credits. And you can see red is on top, yeah, orange is down the bottom, and a couple in between, so what are they? Well, blue is the S&P 500 straight, the total return is in red, orange, which is down the bottom, is the ASX 200, and then if you add in the franking credit, it becomes green. Good, we've cleared that up. Now, give me CAGRs. Well, the S&P 500 over that time period returned 186%, or 11% CAGR, right? Add back in your dividends, you get 13.1%, right? The XJO of the period of time is 4.83%, or 10.8% if you put it back in your dividends. Let's squish them into a table and see the difference. So remember, this is strictly over exactly the same time period. Australia returned 5.97% in dividends, the US returned 2.1%. Boo! If you're into dividends. So the data is 100% clear, there's really no comparison. Stephen is going to go 100% in the ASX, 0% in the US. I mean, why would you? The dividends there are much lower. I've just noticed one thing. David, who's the person who asked this question, has got an M beside his name. What does that mean? That means he's actually one of my channel members. The other thing I noticed is 9 days ago, that's when he asked his question. That's just like hardly any time.
Excuse me, that's not fair. I wait months for you to answer one of my questions. What is going on? Just because he's one of your channel members, you give him favoritism?
Well, this is true. I do favour my members' questions. I tend to put them before other non-members. Escandalosa. So if you want to get some of the perks of being a member and get a bit of favoritism yourself, hit the join button below this video. Now on to Kylie. Kylie is terrified of making a capital allocation mistake. Wow. Okay, so Kylie believes in market cap weighted funds. She invests in index funds. If you believe in market cap, then you should believe in market cap across the entire world. Why stick just to your country? BHP, the biggest in Australia, but it's tiny in comparison to, say, Apple. If you truly believe in market cap and you believe in the concept overall, then why don't we compare all the countries across the world according to market cap size? So here it is. This is the entire world, or at least the first 14 countries. The United States is up the top with 44 trillion. China, Japan, Hong Kong, and at number 14 there is Australia at 1.7 trillion. Notice we have other countries to invest in as well. It's not just the US and Australia. But if I look at the question, nope, that's just what he's asked for, just these two countries. So if you're asking the question, how much money should I put in the US? How much should I put in Australia? An obvious way of looking at that is to look at the market capitalization, and we'll do that in a chart right now. United States is 44 trillion, Australia's 1.7 trillion, add them up, it gives 46. Of that total, United States is 96.3% of it, Australia is a measly 3.7% of it. So there's your answer for that. If you believe in market cap weighting, well, we'll extend it across to the world, and there are your percentages right now. So Kylie invests 96% in the US and 4% in the Australian Stock Exchange. Now on to Justin. Justin likes to min-max. So what does min-max actually mean? Minimize your downside, maximize your upside. In other words, he likes maximum return. He doesn't care about dividends specifically. He doesn't care about market capitalization weighting. He just wants the best returns outright. So let's take a look at that. This is the SPXTR, which is the total return of the S&P 500, versus the XJTF, which is the ASX 200, plus dividends, plus franking credits. And we notice the blue line is in top. Yeah, basically all the way. Who is blue? Well, that's the S&P 500. The S&P 500 total return has returned 247% or 13.1% CAGR. Over the same time period, Australia has returned 181% or 10.8% CAGR. Based on the data, it's quite clear. S&P 500 total return actually beats Australia total return. But what about dividends? Well, that's the total return plus franking credits that's already calculated in, and based on the data that we have, which is 10.1 years, but that's a maximum I can get. Why is that the maximum number you can get? Well, you should ask S&P Global, who I get the Australian numbers from, particularly with the franking credits. It's really, really hard to get, and that's all the data I can get. But do you know, I have more than they're prepared to give. Because as I'm actually collecting that data, I'm actually now going back in time. And if you ask me in 5 years' time, I'll have 15 years worth of data. I know this is the advantage in actually collecting the data yourself, is you can actually have a lot more than data sources are prepared to give you. So Justin goes 100% US because he's trying to maximize everything. He's got no reason at all to try to balance out his countries. What about currency as a risk factor? Should we actually look at that and consider that in? Well, let's take a look. This is the IVV, which is the S&P 500. What is it? It's an ETF in Australia versus the IVV US version. The US version, of course, is not available on the ASX. The IVV AU is, and that's over 14.9 years. So besides one being available on the ASX, the other one you'd actually have to go internationally. There is a difference, and that's the IVV as we know it here in Australia is actually measured in Australian dollars. So as the currency shifts, you'll notice actually that the IVV Australia will actually go up or down with the currency. So it actually factors in that risk. So let's take a look at what it's been over our data set. They start off the same. Red goes underneath, they cross, red is on top, and then blue is on top, and blue is on top. Who is blue? Blue is actually the Australian shares. Aha! It's still the S&P 500, but it is the Australian version of it. Wow! So you notice that crisscrossing? That's because the currencies were actually moving, and that's what you're seeing in the graph. So the total returns, well, the Australian version is 264% over 14.9 years, which is a CAGR of 9.05. If you're investing directly over in the US, it would be 182%, which is 7.2% CAGR. So is this like a hedged version? No, this is actually exactly the same index. You're actually owning exactly the same, except one's in Australian dollars and one's in the US. It's the only difference. So that's easy, right? Just invest in the Australian version of it. Well, you can, and for tax reasons, you might want to do exactly that. But I can't say with a high degree of confidence that the currency will actually always go in the favour of Australia. Over time, currencies tend to even out over time, right? So if currency has gone in the favour of Australia for the last 15 years, over the next 15 years, well, it might reverse. With currencies, I can't say. There's no positive expectation either way. So now you have 3 different strategies of how you could possibly allocate your money to Australia and the US. So which is the best one for you? That appears to me to be a you question. You have all the data. I've given you everything that you could possibly need. And now you decide, if you want to, exactly how you should allocate your own money. How exciting. While you're considering whether you should invest in a US ETF or an Australian ETF, do you know you don't have to invest in either? You can actually roll your own index fund. It is true. Wow. How would I go about doing that? You can click on this video and find out here, or if you've seen it, click here.